There we go. I think. Are we recording? Is this thing on? That's funny. Let me see here. Yes, yes. Okay. Usually I see a red light, but I'm not seeing that. That's okay. All right. We're ready to do managerial accounting's second half of the final exam review. So we're going to work on 6 exercises, 7, 8, 9, 10, 11, 12. Those are the chapters we have yet to do at least one exercise in. All right, so I've got my spreadsheet opened up and I'm going out to the review now on Cengage. I think this works out pretty well. I got this done. No, my other class is also waiting for this video. We got through the first 6. There was one that I had a little bit of troubles with, and it was material that I remember back that I was still a little fuzzy about it, to be honest. So I've got a little spreadsheet to help us. So number 7 is where we're at. So number 7 introduced us to the idea of separating variable costs, right? Variable costs vary based on either production or sales, right? Usually it's sales. And sales vary. So variable costs vary with sales. And then there's fixed costs. So separating variable and fixed costs started in chapter 7. Well, when we do that, we have the old absorption method and we have the new variable costing method. So let me show you. I've got a spreadsheet here. You might make a couple of notes because this is a little bit complex, okay? And if I was a student learning this, as I was kind of reteaching it to myself last night, I would probably not understand it real well, but I could maybe walk it through a procedure, okay? So sometimes you have to rely on that when you're first learning things, just because you're not real sure what's going on. So let me show you the absorption method versus the variable method, right? So real quick, absorption costing. This is what we've been doing all through financial accounting and some this semester, right? That leads to this. So if we think about absorption costing, we think about sales, right? And remember, when we were working with manufacturing, when we did manufacturing, we had 3 inventory accounts that we ran all our costs through until they got to the cost of goods sold, right? We went through materials, work in process, finished goods. When something is sold, it's usually sold out of finished goods. And the answer to the cost of the goods sold is when the inventory costs cross over into being an expense for the cost of what we're selling, right? Before they're the cost, those inventory accounts sit on our balance sheet as assets, right? As assets. But all assets are either turned to cash eventually or expensed. And in this case, it's turned to an expense. Inventory accounts are turned into cost of goods sold. Well, here's the thing. Absorption costing does not separate out variable and fixed. It does not. So you've got direct materials, direct labor, manufacturing overhead, and anything fixed that's at the plant or the factory is in cost of goods sold, okay? When you do variable costing, those things get separated because accountants believe that the variable costs that vary with the volume of sales or production is really more of a true picture of the costs than those that have fixed added in. Notice, fixed actually gets pulled out of cost of goods sold and is placed down here with fixed selling and admin. If there's any variable selling and admin, it gets put up here, right? Before the contribution margin. So I'm going to show you a little bit of a recipe to answer this question now. So now that we kind of have the form of an income statement side by side, when we get down here to this operating income, up to now, we have seen both of these numbers be the same. The reason is this rule right here, this third rule. When the number we produce, right, number we produce equals the number that we sell, then the variable income here and the absorption operating income here, they're equal to one another. So as long as sales equals production in the number of units. So like I said, here are the rules. But when they differ, right, when we produce a different number of units than we sell, which can happen if we want a certain amount of inventory and we don't ever want to run out, then we are probably going to produce more than we sell pretty frequently, right? So with that being said, here's what you need to do. Let's start off. What they want to know is this. So let's just read through this and then I'll tell you the pieces that you need to put down and what you need to calculate. All right. So variable manufacturing costs are $119 per unit. Okay. And I'm just going to read this and then I'll put it in my spreadsheet. The fixed costs, fixed manufacturing costs are $79,800. The sales are estimated to be $3,500. Right? So when we first start off, usually our sales equals what we produce, right? So right now sales are $3,500. That's an estimate, by the way. And then our production is also $3,500. But they kind of worded this weird. So it says, how much would absorption costing operating income differ between a plan to produce 3,500 units and a plan to produce 5,700 units? And then the second question is, how much would variable costing operating income differ between the two production plans? All right. So here's what we're going to do. Let's put down what our fixed costs are. Okay, whatever yours says. Mine is $79,800. And I'm going to put down the estimated units of sales and production, right? Sales and production, which are the same at first. So I want to put production, oops, right? And that's 3,500 units, okay? 3,500 units. So I'm sitting here with the original plan, which is fixed 79,800, 3,500 units. And then I'm also going to put the variable cost per unit right here. So everything is in from the problem. And now we're going to calculate the fixed costs per unit with this much total divided by this many estimated units. So I'm going to change what this says because I have a different problem than I did yesterday. That's okay. So 79,800 divided by 3,500 gives us a certain fixed cost per unit. Fixed cost per unit. Now that's not the answer, but this is going to get us there. Okay. So I would establish what that fixed cost is, because this prediction was based on sales and production equaling 3,500, right? And what's the rule? Now we're going to change it. Now we're going to change it. Now we want to see what the absorption income will be if we change production. So this could be either an increase or a decrease, but right now they want to increase. So they want to go from 3,500 units to 5,700 units. So now I'm going to type this in. Okay. So here is our old production estimate. Here is our new. Okay, I would label that. And now we want to figure just what we did here. We want to calculate a fixed cost per unit based on the new unit volume. All right. So therefore, my problem is going to show 79,800 divided by 5,700. Okay, $5,700, because when these fixed costs got started, they started with this many, but now we're going to see, and apparently our fixed costs do stay the same, even if we increase the units 2,200, right? All right, so now let's calculate what the new fixed cost would be. So it was 2,280 when there was only 3,500 units. But now when we take 5,700 units, if we divide our fixed cost by 5,700, yes, we're going to get a smaller number, and it is 14. Okay, now what you'll want to calculate is what is the difference of the number of units. So once again, our new, right, is 5,700. If we subtract 3,500 from it, we get the difference in units of $2,200. And I want to show this in my screen here so that you understand that's what I got. All right. So once again, calculate the new number, calculate the difference in the number of units produced. So we're looking at 5,700 minus 3,500. Okay. 5,700 minus 3,500. So here we set. So now we have the two pieces that we need. We need the change in the units, because now what do we have, right? I want to put this down. So now we have produced 5,700, but the plan is still to sell 3,500. Okay, so remember, these are numbers, not dollars. Okay, so, and there you have it. So this is the new thought. This is the new occurrence. And what happens when production is larger than sales, right? I'm going to put the outcome down. Okay, I'm going to put the outcome down. So back when it was 3,500 and 3,500, then both of these are the same. Okay, but now that production has increased and sales has stayed the same, what we can expect is variable costing. Even though this is not what they're asking, I'm just trying to teach these concepts just a little bit more. Okay, so that's on this side. That's going to be smaller than our absorption costing. Okay, so one more time. I'm going to move this over, hang on. And I'm going to put, okay, so this is the sign, smaller than. Okay, smaller than. So once again, variable costing will be smaller. Variable costing income, remember income? This operating income, if we do it this way, will actually be smaller than this one. This one will be bigger because, and I'll try to explain it. Here's why. The difference, so now they're asking, what is the difference? How would absorption costing operating income differ between a plan to produce 3,500 units and a plan to produce 5,700 units? So here's why you get your answer. Okay, the difference in absorption income between 3,500 units being produced, right, and 5,700 units. That's what they're asking. Okay, so there's a way to calculate this. And one more time, the difference in absorption income between 3,500 units produced and 5,700 units produced. So you do need to know that it's the produced part that has changed. Okay. So we have 2,200 units more in production with the new 5,700, and we're going to take that number times the new fixed cost per unit. The new fixed cost per unit. So here's the answer. The extra units times the new fixed cost. And you say, how does finding a fixed cost result in more income? Well, and I'll try to explain it. So one more time, I'm going to fill this in here just a second. Whoop, 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 whoop. Let me go back. All right, here's how it works. So we had a 2,200 increase, right? 2,200. And its new fixed cost is 14. What was the fixed cost before per unit? 2,280. Yeah, when you divided fixed by a lesser number, of course you got a bigger number. But when you divide it now by a bigger number, then you get a smaller number. So we're going to take 2,200 times its new fixed cost per unit, which is 14. All right, so here's why. And if you don't understand, hang in there. So absorption costing, and we didn't calculate what it was, but the fact that our units have changed and we're using absorption, how you figure out how much extra income you'll have, you do this math right here. So the answer is an additional income amount of 30,800. And here's why. It says absorption costing operating is higher by this amount because these fixed costs are not included in cost of goods sold. They are still in finished goods inventory. So the increase in operating income is equal to the extra units produced by the new times the new fixed cost per unit. Okay, the reason is if we're selling 3,500, how many do we still have in inventory, right? If we produced 5,700 and we sold 3,500, there's the 2,200 that we're talking about. 2,200 of the production that we didn't sell is still sitting where? It's still sitting in ending inventory, still in ending finished goods inventory. Okay, that has not been sold. All right, that has not been sold, but the old way of using absorption has got the fixed costs in as an asset. So fixed costs are sitting there. So the extra fixed costs are in inventory, right, are an asset. Okay, so if your costs are in inventory, that's sitting on the balance sheet. But we are showing that it should be in cost of goods sold. So the fact that these costs aren't in cost of goods sold gives you more income. Yep. So 2,200 units are still in finished goods at a cost of $14 each for their fixed. And that 14 times 2,200 is 30,800 that's still in finished goods ending inventory. So the extra fixed costs are not in cost of goods sold, right? Are not in cost of goods sold. So income, operating income, remember cost of goods sold is subtracted from sales. Operating income is $30,800 higher because it is missing costs. because costs are not, are missing. Our costs are missing from cost of goods sold. Okay, cost of goods sold. So that's the best I can do. This is kind of difficult. Okay, it's kind of difficult. But once again, 2,200 units are still in ending inventory that were not sold. Now, once again, if we sell what we produce, then all of those costs are where they're supposed to be. And there is nothing lingering around waiting to be sold, right? So that's the idea. So once again, that's the amount that the operating income would actually go up because of the excess units and their fixed costs not being in cost of goods sold. Okay, that's the best I can do. All right. But then if we looked at variable costing income, okay, variable costing income. So I go back up here, here's variable costing income. Notice there is no fixed costs at all until after the contribution margin. So fixed costs, even though that's for the plant, and even though that could be some manufacturing overhead, if it's fixed, then it is treated as what they call a period cost, not a product cost. Only variable product costs are treated as cost of goods sold and selling and admin before you get to the contribution margin when you're using this method. The fixed are all shoved down here and wait until after the contribution margin. So if you change, right, if you change amounts of units, right, are you changing? Okay, so here's the question. What would variable costing operating income differ between the two production plans? So if all your fixed costs are down here and it's not going to affect anything up here, then the number of units that is produced versus sold doesn't matter. It doesn't affect the income. Okay, it does not affect operating income. So the answer is 0. And I'm sorry if that's not real naturally intuitive. I had to think about a good way to explain this better because I don't think I did very well when I was teaching it. So anyway, there you have it. Let's check our work. Okay, check our work. So the moral to the story is accountants, when you're comparing income and you're adjusting what you're producing, then they suggest using variable costing because you don't get this distortion of your income. This is a little bit of a distortion of your income because you did use those costs. You just aren't showing them yet on your income statement. They're still sitting there on your balance sheet. This takes care of that. This doesn't let those fixed costs sit there. They're treated as a period cost. So everything is kind of lined up no matter what happens with the units produced versus the units that are sold. Okay, moving on. All right, I know we've beat that to death. All right, that's a difficult subject even for me. All right, the next one is the budgeting chapter. Okay, the budgeting chapter. We had several budgets that we were exposed to. We have a production budget, we have a sales budget, then a production budget, and then everything feeds off of those decisions, right? So the one I'm going to have you work on can be a little tricky, but this is the direct materials purchase budget. All right, so let's get started. And I've got kind of a replica of what we have here. So it says that the Crawford Candle Inc. Company budgeted production of 720,000 candles for the month of September. In the month of September, I got September there. It says, assume that 11 ounces of wax is required for each candle. So I want to put that down. The last one I did required 10. Okay, so now my problem requires 11. Okay, now you're going to get some beginning balances and ending balances of this material. But right now we've got it in ounces. It looks like we have to convert it into what? Pounds, right? We have to convert it into pounds. So I'm going to make a little notation here, because if this is the amount of wax we need 11 ounces times 720,000 candles, right? And then we're going to convert the ounces to pounds, right? The ounces to pounds. So here's how many ounces. How do you convert that to pounds? You divide this big number by 16, all right? So next to this, even though it says pounds, I'm going to put divide by 16, right? In order to get your pounds, okay? In order to get your pounds, we've got to divide this by 16. So I guess that really goes up there. Let me do that. Hang on. Okay, so we're going to divide the ounces by 16 to get pounds. And I said convert ounces to pounds. So there's 16 ounces equals 1 pound. All right, and then this one we want divide by 16 ounces. All right, divide by 16 ounces. That's how we're getting 495,000 pounds. All right, so let's go ahead. The first thing on this budget is to put the pounds of wax required for production. Well, here's the production that we are planning for September. And then they gave us the ounces and we did the math there. And then we divided by 16 to get the pounds. So this is the pounds to produce that many candles, right? And I'll put pounds to produce production candles, right? Budgeted production. Budgeted production volume. Okay, volume. So let me give you one more insert here. So that's the first entry that we're going to put down. We're going to put candles. Okay, how much wax in pounds does it take to produce 720,000 candles? All right, so that answer is 495,000. Now, what goes next? Well, in inventory, when it comes to budgeting, most of the time we don't want to run out of whatever it is we have in inventory. So to keep from running out, we need to put down how much we want to have in inventory when we're finished, right? When we're finished with the production, we're going to produce 720,000 candles. And that's going to take 495,000 pounds. And then we have a desired ending inventory. So let's find that. The desired ending inventory for September is 13,700 pounds. We want to add that to the pounds of wax we need for production. So 13,700. And here's our desired ending inventory. And once again, it's 13,700, and you'll want to add down. There are the total pounds of wax that we want available, okay, that we want available. So I've got 508,700, okay? So then the last calculation is to go and find the estimated beginning inventory, because we started with pounds of wax, right? And we need to show that the 1st of September already had wax sitting there. So if this is what the total is you need available, then you should be able to subtract what was sitting there because it doesn't need to be purchased, right? So the estimated beginning inventory needs to be subtracted, right? So I got 17,500. And let me put that number here, 17,500. Okay. And you're going to need to put that in as a negative. And then you get the total pounds to purchase. Okay, to purchase 491,200. Now I need to go find the price. If wax costs $1.60 per pound, so I need to put $1.60 here and here as well. Oop. Okay, so last problem I did was $1.20. All right, there is the $1.60. And then that gets taken times the pounds to purchase, right? Pounds to purchase. So 785,920. If, let me double check my calculation is correct. There's the number of pounds times the price. There you have it. So this, I just saw an error. I just keyed an error. So I think my brain caught it. 785,920. So in order to produce the candles, what, 720,000 candles, we're going to need to buy $785,920 worth of wax. Yep. Okay, so this is purchasing that will need to help us with this. Maybe they could even find it for less than that price. Hope it's the same quality of wax. Okay, moving on. Moving on. All right, number 9. Okay, number 9 is about variances. Variances are amounts that are different between what we had estimated with a standard to what actually happened. Okay, so there is a direct materials variance, there's a direct labor variance, there's a lot of variances, but this one's going to focus on the direct materials variance. Remember, variances are either calculated to be favorable or unfavorable. And the fact that we are looking at costs, the more we spend, the less favorable it is, or the more unfavorable it is. So let's put down some information, okay? Remember, negative variances are favorable. Positive variances are unfavorable. And that was something that I had to get over because I was taught the other way around, but that's okay. Put on a different hat. I would recommend that you put down your information. So remember, there's AQ, which is actual quantity, AP, actual price, SQ, standard quantity, SP, standard price. So let's start trying to see if we can find some pieces here. So we're CFIN Coatings Company, produces a product that requires 11 standard pounds per unit. I'm over here and I've got SQ. Now, per unit, I've got things per unit here, but I've also got a place to put in some volume. So how many units standard wise? So it takes 11 pounds per unit. So I've put that in, and it's up to you, but so I know that I have looked at it. I'm going to color it purple when I know. The standard price per pound, right, is $8 for mine. So I'm going to put $8 here. Okay, so we're already starting to get pieces. Now, the pounds is not complete yet. The price is fine. The price is fine. So standard price is fine. We hope to spend $8 or less per pound. We hope to use 11 pounds or less per unit. Okay. If 5,800 units, that is probably the most important piece of this. 5,800 units, the actual output. You say, why aren't you putting actual output here? I do have it here. So I've got it 5,800 units, but I've also got it here. I don't know, I guess it's to help me remember. All right, so 5,800 units. It says we used 65,700 pounds. I'm going to key that in here. Okay, so 67,500 pounds. Now I said I would key in the things that are purple, right? So I keyed that and keyed that. All right, so then here is our actual price, $7.84. So I'm going to put that here now, $7.84. So everything's purple that I've keyed in. All right. And all right, so let's go ahead and start setting this up. The first group we're going to look at is to compare the price that we paid. So we hope to pay $8 a pound. What did we pay? We paid $7.84 a pound. So right away, that looks like that's favorable. Okay, that looks favorable there, right? Spending less than $8. So when we get to that, we should be thinking about that. And we're just about to do that. So what this takes is the actual cost, and the calculation is the actual quantity times the actual price. So they told us that we used 67,500 pounds. They told us that our actual price per pound is $7.84. When you do the math by both of those, I got 529,200. Now I'm not done yet. Okay, I'm not done yet. This is the answer of these two multiplied together. And that's what I have here. It is actual price minus standard price times actual quantity. Notice actual quantity is used here and here. Actual quantity. So that first amount is the same for both of these. It's the second amount that's different. It's actual price and standard price. So we have a variance here. So we did the math of, we did the multiplication of these two numbers and the multiplication of these two numbers. And we get a variable that's negative because we spent less, right? This is spending less, 529,200. That's spending less because of the price we found than we expected it to be. So this is a negative 10,800. So my price variance, and I'm going to put it in whatever sign it says, but we have to remember that negative variances are favorable. Yep, negative variances are favorable. So let's see if I'm right. Oop, hold on. I must have not calculated this correctly. Just a minute. Well, we can't come up as favorable. Nope. Okay, so let me see what I've got here. Standard price is 8. Yes. Standard, or it costs $7.84. That's that. $7.84. Yes. Yes. Okay. We made 5,800 units. Okay, I'm going to come back to that. Just a second. Just a second. So once again, this should be the price variance because it's the difference between the two prices, right? If you take, let's do it this way. Let's follow this formula here. Let's take the actual price minus the standard price, and that goes in parentheses. And then we're going to take it times the actual quantity, right? Actual quantity is the same for both, so it doesn't matter. I got 10,800. Use 65. Guess what? I have a transposition error. Yep, there it is. right? Yep. So having this is going to help me a lot. Sorry about that, guys. It happens to the best of us. But that's why having the notes, I needed to go back and look. So now I think we're in business. So this is the actual quantity. But once again, this is comparing the price. And the reason we know it's comparing the price is because both of these are using the actual quantity. All right, so now we're looking at a negative 10,512. There we go. So it was a transposition error on my part. All right, so now let's go to the quantity. So let's see here. And I think this one can be the most difficult to find, okay, is the standard quantity. Because sometimes they throw around other language. All right, so we're going to use what's in the middle here. And now we're going to compare it to SQ times standard price. So the standard price is going to be the same for each calculation. Here is the actual quantity that we used. Now here comes, this is the hardest part. This is the hardest part, is to find the standard quantity we should have used. So this, to get this, right, let me show you. You'll want to use the actual units that we created, but times the number, the standard pounds per unit. So I'm going to show how this is calculated here. Okay, so down below, I'm going to put, so once again, it's, how did I get this? I took the actual quantity. This is SQ. How do you get SQ? Right? SQ, and I've got SQ up here blank. SQ is going to be the actual output times the standard, what it should have been. So there it is. And I calculated that so that now I can use that. Whoop, there's bigger. Now I can use it over here. Okay, now I've got too big, sorry. What in the world? Okay. All right, so now I can use this amount over here. So in fact, I will put that to equal that. All right, so I didn't input this amount here. I calculated it. I calculated this. This is calculated, right? So a lot of times that's the case in these problems, calculated. You get all the other stuff, but you have to calculate that. Because if you just put 11 pounds in compared to 67,500, that's not comparing the right volume, okay? This is just one unit, but this is 5,800 units. But the actual quantity that we used was 67,500, I believe, right? Yep, because here's how much pounds we actually used, because we took the material, they told us, divided it by 5,800, and this is going 0.64 pounds beyond the standard. So this one is going to be unfavorable. It's just a matter of how much. So now let's calculate it. So how do you get the calculations for this? Here's what we're doing. Actual cost. Nope, here's what we're doing. Actual quantity times standard price times both standards. Okay, so both standards go here and both actuals go here. And in the middle, you get your AQ and your SP. And that can be sometimes a little difficult. So when we take our actual quantity times our standard price, we get 525,600. Then we figured out our standard quantity by taking the actual number of units that we produced times its $11 pound standard per unit. That's 11 pounds of material. So it looks like we actually had more than the standard. And this is a positive number, 15,200. And remember, positive numbers are unfavorable. All right, now we're ready to net. Now we're ready to net because you net both of these. You net both of these. So if this is sitting here with a larger amount of a positive number, and positive is unfavorable, negative is favorable, this is a positive number. Since this is positive, then this is still unfavorable, right? Because the unfavorable outweighed the favorable. So here you go. Okay, so the final direct materials cost variance is these two netted together. So $4,688. And we're still unfavorable because unfavorable is bigger. All right. And the thing is, if all you did was figure this, if all you knew was that there was an unfavorable variance that has to do with direct materials and the price of 4,688, we would have never seen the favorable about the price, right? We wouldn't have found that. So that's why it gets broken out into two separate amounts, because one might be favorable. They both might be unfavorable. An unfavorable and an unfavorable add up to a bigger unfavorable. A favorable and a favorable add up to a bigger favorable, and so forth. Okay, so it was important to learn how positive and negative numbers work together and offset each other. All right, that's it. That's it for number 9. Moving on. I know things are all right. So now we're going to start doing some analysis, right? Analysis when we do some income statements and things. So we're going to find the profit margin, right? The profit margin is the component of the rate of return on investment. You don't invest your money hoping you won't get a return, right? The point is you hope you will. And in fact, you're willing to take the risk that you will. Here's how it's computed. It's a ratio, okay? It's a ratio. The ratio is for the profit margin is operating income divided by sales. Operating income divided by sales. So I went ahead, I have operating income here of 93,600. I have invested assets of 260,000. And then I have sales of 780,000. I would, 780,000. I would put those in a spreadsheet or on a piece of paper. So then the first one is operating income. So there it is, divided by sales. So I got 12%. It says round your answers to 2 decimal places. So this should really be 2 decimal places. There you go. All right, so how did I get it? I took operating income. Remember, that's what we have left over after a lot of expenses and costs have been subtracted from sales. So in other words, we're hanging on to about 12% of every dollar. All right, let's put that in. You can check it if you want. I'm going to move along. The next one is called investment turnover. So you have investments, invested assets, and you're selling based on those invested assets. So comparing the two, so you're going to take sales of 780,000 and divide by the invested assets. And what that means is that the assets that we have been turned over 3 times into sales, right? The higher this goes, the better. That's the point of investing assets, is to eventually grow the business, and the sales are 3 times the size of invested assets. So it's just a number. It's just a number, but we need to put it in as 2 decimal places, as well as I need to put this one in as 2 decimal places. Okay. Now you can do the math. These two are needed for this one, the return on investment, ROI. Okay, return on investment. This is a very popular measure of profitability. So you use these two. So you take 12% times 3. Okay, 12% times 3. And I got return on investment of 36%. And I want to change this to 12% times 3. So that was doing the math here. So you got to find these before you can find this one. So I don't know about you, but with this profit margin, look how, I guess you could kind of see this investment turnover as a multiplier, because what was just 12 now turns into 3 times that much, right, of return on investment. All right, so we're just practicing doing this because a lot of cost accounting is analysis, right? All right, let's go to the last two then. So chapter 11. Chapter 11 was a decision-making chapter. There were several decisions that we were asked to calculate and make a case for. This is called a special buy or a special price. Special price. So if a manufacturer is working, they have a normal selling price, right? So let's see if we can read through this. A product is normally sold for $47 a unit, but they have been requested to sell it at just $33 a unit for the export market. Okay, so it's some kind of special deal. The variable production cost is $26 per unit, and there is an additional export tariff of 12% of revenue that must be paid for all export products. Assume there is sufficient capacity for the special order. So you wouldn't even consider a special order unless you had the capacity, right? If you don't have the room to make it, might as well forget it. All right, so we're going to prepare what's called the differential analysis. We're going to compare alternative 1 to alternative 2. And then we're going to look at it from alternatives 2's point of view. So let's see what we have here. It says revenues per unit. If we reject the order, are we going to get a revenue? Nope. If we accept it, we're going to accept it for the $33 that it is. And then this is adding across this way. So the differential is $33 for accepting it. Okay. If you don't accept the order, you have no costs. So we might as well just fill in 0 here, because if you reject an order, nothing is going to happen here unless they say something special does, and they didn't. All right, so here you have it. Now we're going to go to variable costs. Okay, variable costs are $26 each. Okay, and that means, and this is a cost, so it goes in as a negative. It's a cost, so then negative 26. Okay. And now this export tariff, it says to take 12% right here. I've got mine 12%. It calculates 12% of the revenue. 12% of the revenue, and this is an additional expense. Okay, so that number is $3.96 as an additional expense. We're going to put it in as a negative. Okay, and it comes over here. I got 96, negative 3.96, negative 3.96. And now we're ready for calculation. So we're going to take the revenue and subtract, and we get a profit of $3.04. $3.04. So the good news is that since they had capacity, they could make a little extra, and depending on who the special order's for, maybe it's a charity, It could also provide some public service, a public service image if this is for charity or something. And so they say that, and they didn't say, do we accept, oh, yes. It says, should we accept the special order? The fact that these come out a profit, right? Anything below a profit or zero, I think would be no, right? So if you shut this down and didn't do anything, you would be worse off because you wouldn't have this 304. So the fact that this is a positive number above zero, then that usually indicates that you'll accept it. Okay, you'll accept it. Last question. This is for evaluating capital investment projects. This was our last chapter. And we used time value of money here. Okay, in fact, we're going to use the analysis called the net present value. Net present value. So I'm going to scroll down. So we had, I think, four different evaluation methods. We had average rate of return, cash payback, net present value, and internal rate of return. These two use the present value idea that today's money is worth less than if you were to put that money into an account that has interest, your money would grow. All right. So we're only going to work with present values for this one. There are future values, but we don't need it for this particular method. So we're going to use what's called the net present value. So present value and the word net means something's been subtracted somewhere before we got to this number. All right, so I'm going to scroll down to get to net present value. All right, let's read through it. A project has estimated annual net cash flows of $6,250 for 10 years and is estimated to cost $42,500. All right, so they're projecting a cash flow of $6,250 over the next 10 years, but we've got to invest or make an investment of $42,500. All right, so we're going to put this in as an annual cash flow because this is an annuity. How do we know it's an annuity? Notice the annuity chart is being used. The other chart doesn't have the word annuity. How we know it's an annuity is that it's the same amount for several years in a row or more than 1 year in a row. Okay, more than 1 year in a row. So I'm going to change my spreadsheet to say 6250. And this is going to be for 10 years. So I counted for that. Our rate of return, we have a minimum rate of return of 6%. I am documenting that. All right. And then our estimated cost is $42,500. Now I need to use this table, okay, because I've got to find the factor that I need. How do I find it? This is for 10 years at 6%. So you go find your 6% column, go to 10, and there sets the present value factor that you'll want to use in this problem. So 7.360, and I've got this set up to do the math. So what is the net present value of the project? So the first thing we calculate is the net cash flow. This is the present value of the net cash flow. So this is the 6,250 basically times that present value factor. Without present value, here's something to consider. Without present value, we would have just taken 6,250 times the 10 years, right? Without, so I'm going to put without time value of money. Sometimes it helps put it in perspective. time value of money, TVM. There it is. But with it, right, that's 10 years into the future. That's an annuity each year. And that's times whatever factor came to 6% in 10 years. So today's money, right, which is supposed to get this within 10 years from now, this amount discounts back to that amount. We've got one more piece before we can answer this question. Since now this is net cash flow, okay, net cash flow, but then we need to subtract the estimated cost. Okay, so net cash flow is your annual net cash flow times your present value annuity factor. Then we're going to subtract the estimated cost. And it looks like we've got project net present value, right? Net present value of the project. I guess I need to say that better. Net present value of project. So it looks like it's $3,500 if I've got things in here correctly. Okay. Because we do have to subtract what we invested to even get this started. All right, let's see if I'm right. Okay. Now we're going to use the present value index, and we're going to round to the 2 decimal place. This one is rounded to the nearest dollar. Okay, nearest dollar. So now we're going to the present value index. Okay, the present value index. And there's a formula for it. You take your net cash flow, which is right here, and you divide by your estimated cost. Okay, so I'm going to take my net cash flow, which is your annuity times whatever present value you found when looking it up, 6% in 10. And instead of subtracting like this one is, well, how about calculating, right? Calculating. So we're taking net cash flow divided by the estimated cost. All right, so it's 1.08. 1.08. And you say, what does that mean? What does that mean? Well, for every dollar of cost, here's the dollar of cost. $1.08, which isn't as good as the last one I did. The last one was $2.45. $1.08 of cash flow is received, right? For every dollar of cost, which is down here, there is $1.08 of cash flow received. So this is so the analysis is favorable for the project. Okay, the analysis is favorable because once again, we invest, if a dollar is invested by buying whatever it is, the technology, the project that we're getting ready to do, if we have to plunk down 42,500, we're going to get $1.08 of cash flow received. So 8% more than what we're putting in, right? So we're getting the dollar back, but we're getting 8% on top. So it is favorable, but they don't have a place to choose that. All right, that's it. Okay, that's it. We have walked through the last 6 review questions. Okay, so I see I have 4 of you left. That's okay. I just want to say thank you for the semester. Keep pushing. If you're thinking about accounting, don't rule it out. Okay, don't rule it out because you never know where it might take you. All right. So if you're decent at this, then you might just put it in your back pocket. Maybe you already know you want to go into accounting. I think it's definitely one of the best business degrees you can get. Nobody will ever say, wow, they didn't work very hard. They'll say, wow, they worked hard. Okay. And of course, it could set you up to take the CPA exam. You can go into finance. If you're not that crazy about accounting background is always good for just about anything in business. So that's all I got. All right. I will see you later. Have a good summer. Have a good summer, guys. I'll start watching for your grades to fill in. Okay. Thank you very much. Appreciate all of you.